shelter component of July Consumer Price Index, which makes up a third of the overall CPI index that increased more than 7%. Investors are eagerly awaiting August's CPI report, which is set to release Wednesday ahead of the Federal Reserve's upcoming policy meeting. For the Fed, it seems taming inflation also means navigating a housing crisis, perhaps. On this particular topic, let's bring in Kyle Campbell, staff writer over at the American Banker, to weigh in. Kyle, great to have you here on set with us. First and foremost, do you think about that housing component there? Is that expected to abate or recede a little bit, or is that something that we should expect to remain hot?
So, Fed Chair Jerome Powell spoke to this a bit during his Jackson Hole address. He said that there are sort of deflationary pressures in the pipeline, if you will. And what he's referring to there is the fact that it takes a while for rents that are either sort of stable from the year before or even potentially lower to show up in inflation indexes, because someone has to sign a new lease, they have to renew in order for that to show up. And both the CPI and the PCE index, which is the Fed's preferred measure of inflation, they focus primarily on rents or rental equivalents for homeowners. So when you see things like rising mortgage costs and home prices, it's sort of a different story. But of course, it's all the same market, and so they are related in certain ways. And how those two sort of interact with one another, I think, is going to sort of determine the trajectory of things moving forward.
But is there a risk there, though, the fact that it does just take into account rent, not so much the buying side of things, that potentially the Fed would possibly have to rethink their strategy, rethink their policy if we start to see more cracks in the system?
Of course, yeah. I mean, or even just, let's say, there's a pause of some sort that gives homeowners who maybe have wanted to sell for a while but didn't want to go out into the market with rising mortgage rates. They might say, well, okay, now I feel like I can actually put my house up for sale. You suddenly have that inventory, and then you have home prices surging. Could that then lead to a change in prices on, the rental side on one end, or just sort of a uptick in broader inflation in other categories? That's the question. Yeah.
What categories would that overflow into?
Well, so I mean, the mortgage, where mortgage rates are at, it impacts labor as well. Because there's a huge, the housing sector is a huge part of the labor market. It could, if those prices are rising, it could lead to other sort of related services increasing in price as well. So it's not sort of the direct cost of buying a home, but it's the things that are affiliated with it and how that sort of interacts with the broader economy.
Kyle, when we take into account the fact that prices have not dropped nearly as dramatically as many of the forecasters were expecting this year, a lot of that has to do with the fact that the supply and demand picture remains extremely out of balance. When we talk about the timeline and what needs to happen in order to get better balance between those two, what needs to happen?
A lot of things need to happen, but it's mostly supply side. Ultimately, prices are not going to abate until supply and demand are better aligned. And of course, the Fed tries to suppress demand by making costs higher. But what we're seeing is that they cannot drive down demand enough to reach the level of supply, which is so low thanks to years of underbuilding and sort of local policies that have restrained housing markets.